Welcome, everyone. We are really thrilled to have you with us today for a brand new deep dive.
Yeah, glad to be here.
Let me just set the scene for you real quick. It is March 3, 2026, and the financial world is currently buzzing because Thales,
Global powerhouse.
right, the massive global powerhouse operating across defense, aerospace, and cyber. They just dropped their 2025 full year results. And I have to say, this press release is an absolute behemoth of a document.
Oh, it is extremely dense. You were looking at dozens of pages covering financial tables, geographic breakdowns.
Segment analyses, corporate milestones spanning the globe.
Exactly. It's a lot to take in.
So our mission for this deep dive is to take those heavy financial pages and extract the ultimate story hiding inside them. We want to see how a massive multinational corporation navigates an incredibly complex, fast-moving world.
Which is fascinating to watch.
It really is. So whether you are an investor looking for market signals, a tech enthusiast who loves the idea of autonomous lunar landers, or just someone fascinated by global trends, this is for you.
We are essentially treating this as a masterclass in reading geopolitical and economic tea leaves, all through the lens of a single company's balance sheet.
Okay, let's unpack this. We have to start with the top-line tsunami of numbers, because the sheer scale of the capital flowing through Thales right now is staggering.
The overarching theme of their 2025 performance is acceleration. In a broader economic context where a lot of heavy industries are fighting just to maintain their margins,
Right.
Thales pulled in an order intake of $25.3 billion. That completely matches their absolute record from 2024. And then you look at the actual sales and they reached $22.1 billion.
And I noticed they highlighted an 8.8% organic growth rate for those sales.
Yeah, that is key.
For anyone tracking the corporate finance side, organic growth is the critical metric because it means this is growth generated from their core existing business operations. They didn't just go out and buy up 3 other companies this year to artificially inflate their revenue number.
Exactly. They beat their own internal targets purely on the strength of their own pipeline.
And that operational strength translates directly to the bottom line, right? With an adjusted net income comfortably over $2 billion.
It does. But the metric that truly defines their current posture isn't the yearly revenue. It is their consolidated order book, which currently sits at $53.3 billion.
Wow. That number gave me a massive aha moment. 53 billion euros in future guaranteed work.
It is massive.
In an industry where a single supply chain bottleneck for a microchip can wipe out a quarter's earnings overnight, an order book of that size acts as the ultimate corporate shock absorber.
What's fascinating here is the concept of visibility. An order book of $53 billion gives a multinational corporation the visibility to commit to massive, decade-long research and development projects without sweating short-term market volatility.
Because they know the capital's coming.
Exactly. Imagine knowing exactly what your paycheck will be for the next 3 to 4 years, regardless of what happens in the wider economy. It insulates them from macroeconomic shocks in a way very few companies ever achieve.
It also gives them incredible cash generation capabilities today. Their free operating cash flow came in at nearly $2.6 billion.
Which results in a cash conversion ratio of 128%.
Which is huge.
They're converting well over 100% of their net income into actual usable free cash flow. And they have maintained that conversion rate for 6 consecutive years now.
That is wild.
You can massage certain accounting figures on a balance sheet, but you cannot fake free cash flow. It proves their underlying business model is turning complex hardware and software contracts into actual cash in the bank with remarkable efficiency.
But that robust cash flow isn't just sitting in a vault somewhere. It is the fuel for their massive operations, which brings us to the real engine of this report.
The defense segment.
The undisputed heavyweight carrying a huge portion of the company's momentum right now.
Absolutely. In 2025 alone, the defense division brought in $15.1 billion in new orders and $12.2 billion in sales.
The demand curve is steep.
Very steep, and you can see it clearly in their book-to-bill ratio, which stood at 1.24 for the year.
I always look at that metric to gauge momentum. Just to clarify for you listening, I assume that 1.24 means for every euro they actually bill out for completed work, they are stuffing 1.24 euros of brand new orders into the pipeline.
You have it exactly right. You are seeing the pipeline fill up significantly faster than it is emptying. Thales has kept that ratio above 1.2 for the defense sector for the 7th consecutive year.
That consistency is incredible.
Consistently securing more new business than you can currently deliver is the strongest leading indicator of sustained future growth. And it is a direct result of the universal increase we are seeing in global military budgets.
And the specific contracts driving that 1.24 ratio really paint a picture of where those budgets are going. The report outlines 20 large contracts secured in 2025, each valued over $100 million.
And the geographic spread covers almost every continent.
Right. They are supplying 26 Rafale Marine jets to the Indian Navy.
They are providing a massive stockpile of 5,000 LMM air defense missiles for the UK Ministry of Defense.
And they are even moving an ammunition assembly line directly into Ukraine. A 70-millimeter ammunition line being transferred from Belgium.
That one is particularly notable. It shows a shift from simply exporting finished hardware to actually decentralizing defense production directly into active regions.
They also secured a massive framework agreement at home with the French Defense Procurement Agency. They're developing the sonar suite for France's third-generation nuclear-powered ballistic missile submarines.
Building subsurface acoustic tech for nuclear deterrence is about as high stakes as manufacturing gets.
Definitely.
If we look at this objectively, these specific orders serve as an unvarnished mirror of current geopolitical realities. Without taking any political stance, an analytical read of this balance sheet shows how regional security demands.
Like the active conflicts in Europe and the strategic posturing in the Indo-Pacific.
Exactly. Those demands translate directly into hardware requisition. This climate of immediate, intense global demand is exactly why Thales is pouring capital into rapidly expanding their production capacities.
But building submarines and missiles is just one piece of the puzzle. The cash is also flowing upward into the aerospace segment, which had a stellar year as well.
Very strong year.
Aerospace saw $5.9 billion in sales, representing an 8.7% organic increase. And the report outlines a twofold success story here. Airlines are flying more frequently, which drives up the highly profitable aftermarket services and maintenance divisions.
And simultaneously, Airbus and Boeing are ramping up production of brand new commercial aircraft. So Thales is selling more original equipment to outfit those planes.
It really is a rising tide lifting all boats in their commercial aviation division, but the commercial side only tells half the story of that segment.
Right.
Here's where it gets really interesting, the space contracts. We're talking about projects that sound straight out of a science fiction novel.
They really do.
Thales signed a major contract with the European Space Agency to develop Argonaut. This is an autonomous, versatile lunar lander designed to deliver cargo and scientific payloads directly to the surface of the moon.
Engineering a heavy payload, autonomous lunar lander, requires overcoming monumental technical hurdles. We're talking about extreme precision in deep space navigation, thermal control, and autonomous robotics.
And their orbital ambitions are just as aggressive. They signed the initial phase contract for the IRIS-2 European satellite constellation. Plus, they landed a massive contract with the Indonesian Ministry of Defense for an observation system combining optical and radar satellites.
Those are undeniable engineering wins. But if we connect this to the bigger picture, the most strategic maneuver in the aerospace segment isn't a piece of hardware.
No.
No, it is a corporate alliance mentioned by their CEO, Patrice Caine. Last year, Thales signed a memorandum of understanding with Airbus and Leonardo to combine their space activities.
Right. They're essentially trying to build a European super team for space.
Exactly. The global space market is facing an existential shift. It is highly competitive and increasingly dominated by heavily funded private upstarts in the U.S., alongside established state-backed programs in Asia.
So they have to adapt.
By joining forces, Thales, Airbus, and Leonardo are executing a strategic consolidation. They need to pool their resources, share the astronomical R&D costs of next-generation satellite constellations, and ensure Europe maintains sovereign capabilities in orbit.
It is a highly calculated defensive and offensive move to secure long-term market share against companies launching rockets every other week.
Precisely.
You cannot build a multinational super team without a little friction, though. Which brings us to a contrarian data point in the 2025 report. Not every single arrow was pointing green.
True.
The cyber and digital segment actually saw a slight organic sales dip of 0.9%, bringing in $3.85 billion for the year.
Unpacking the why behind that slight contraction is crucial for anyone analyzing their operational agility. The cyber business dipped primarily due to the friction involved in merging the global sales forces of Thales and Imperva, the cybersecurity firm they recently acquired.
Anyone who has ever lived through a corporate merger knows it is never as simple as just combining two Slack channels and calling it a day.
Definitely not.
You have rival CRMs, warring sales cultures, redundant management layers, and completely different product catalogs. There is inevitably a period where the pipeline stalls because everyone is just trying to figure out how to work together.
That internal disruption is a classic corporate integration hurdle. Furthermore, their premium services division saw soft demand in Australia.
And on the digital side of the house,
The sector suffered from continued low volumes in the production of physical payment cards. As global consumers move increasingly toward digital wallets and contactless mobile payments, the physical plastic card market naturally experiences drag.
that makes perfect sense. The report does highlight a strong recovery trajectory, though, which is the silver lining here. The cyber division worked through that sales team friction and actually returned to organic growth by the fourth quarter of 2025.
Yes, they bounced back.
And within the digital sector, while plastic cards are down, they saw massive growth in secure connectivity solutions. Things like eSIMs and on-demand platforms. They even landed a huge secure connectivity order from a customer in Asia.
For you listening, this dynamic is a textbook example of why large corporations diversify their portfolios to this extreme.
Exactly. When the physical credit card market shrinks or a corporate merger stalls the cyber pipeline for a few months, the massive defense and aerospace wings provide enough lift to keep the overall company flying high.
The broader corporate structure easily absorbs the temporary localized shocks. The diversification acts as a financial hedge against sector-specific downturns.
Speaking of hedges, beyond the balance sheet, corporate reports today focus heavily on a completely different kind of risk mitigation. We have to look at the Protect program, which is their ESG initiative, environmental, social, and governance.
Investors scrutinize these non-financial performance metrics closely because they offer a window into how leadership views long-term systemic risk.
Most heavy industry companies treat ESG as a PR chore, but the data here suggests Thales is using it as a shield. They had a target to reduce their Scope 1 and 2 emissions by 50.4% by the year 2030. But in 2025, 5 years early, they actually dropped those emissions by 75.2%.
That is a massive reduction.
Just to clarify for our listeners, Scope 1 and 2 emissions refer to the direct greenhouse gases they produce from their own operations and the indirect emissions from the energy they purchase. Slashing that by 75% means their operational carbon footprint now represents less than 0.7% of their total emissions.
Achieving a 2030 heavy industry climate target 5 years early is highly unusual. From an analytical perspective, this is not just about corporate social responsibility. It is about margin protection.
How so?
A company that aggressively and successfully decarbonizes its core operations is effectively bulletproofing itself against future European carbon taxes and stricter environmental regulations. They are neutralizing a future financial liability that will likely cripple their slower-moving competitors.
That is a great point. And they are applying that same forward-looking approach to the human element. The report details the Thales Climate Passport training program.
Right.
They trained over 50,000 employees, hitting 94.6% of their managers in climate awareness. They also highlighted a big push for gender diversity, noting that women now make up 27.6% of the total workforce. More importantly, 69.2% of their management committees now feature at least 4 women.
Diverse leadership teams and comprehensive company-wide climate training suggest a corporate culture that is highly adaptable. It signals to the market that the company isn't just optimizing for the next quarter. It is building the internal resilience required to navigate the next decade of shifting global paradigms.
So what does this all mean as we look ahead to 2026? The report sets some very aggressive targets. They're projecting total sales to land between 23.3 and euros 23.6 billion.
They expect continued margin improvements across the board.
And they fully anticipate that critical defense book-to-bill ratio will stay comfortably above 1. They're also teasing major new technology rollouts like the FlyEdge cloud-based in-flight entertainment system for commercial airlines. The operational outlook is incredibly bullish.
The internal projections are very strong. However, a close reading of the fine print reveals a significant external variable they have to navigate, stemming directly from domestic French tax policy.
The regulatory fly in the ointment, the renewal of the temporary additional corporate tax.
Exactly. The French government opted to renew this specific tax measure. In 2025, that single domestic policy decision cost Thales an unexpected $75 million.
Ouch.
And the impact compounds in their projections for 2026. Thales estimates this renewed tax will cost them an additional €90 to $100 million next year. It effectively pushes their overall corporate tax rate from a normative baseline of 25.83% all the way up to 36.13%.
A 10% spike in your tax burden changes the math on a lot of internal spreadsheets. For a global CFO, dealing with a sudden 100 million hit from your home country has to be incredibly frustrating.
This raises an important question about the friction between borderless global commerce and sovereign taxation. Thales operates in 65 countries. They are securing billions in revenue from the UK, India, Indonesia, and beyond. Yet, a stroke of a pen on a domestic tax bill in Paris instantly wipes 100 million off their global bottom line.
It is wild when you put it like that.
It perfectly illustrates how multinational financial teams must constantly hedge against highly unpredictable domestic political winds.
It proves how fragile forecasting can be, even when you have a 53 billion safety net. You can model supply chain disruptions and currency fluctuations perfectly, but legislative risk is often totally unavoidable.
It requires extreme agility to absorb those external physical shocks without altering your long-term strategic investments.
We have covered a massive amount of ground today. Let's do a rapid-fire recap so you can take the most vital pieces of this deep dive with you.
That's good.
Thales is riding an absolute wave of global defense spending, securing contracts for everything from nuclear submarine sonars to drone defense missiles. They are aiming for the moon, literally, with autonomous lunar landers, while simultaneously building a European aerospace super team to fight off private sector competition.
They're working through the frictional realities of corporate cyber acquisitions, and they are using aggressive climate targets as a financial shield against future regulations.
And they are managing to do all of this while sitting comfortably on a 53 billion a portion of guaranteed future work.
It is the exact profile of a company operating at peak industrial capacity across multiple high-stakes domains. But before we wrap up, there is one final lingering thought I want you to consider, based on a single line buried near the end of their report regarding future investments.
Let's hear it.
The source states that Thales allocates a staggering $4.5 billion a year strictly to research and development. They specifically note that a massive portion of this capital is being channeled into artificial intelligence, quantum technologies, and cloud computing for critical environments.
Pumping 4.5 billion a year into R&D is a massive, relentless bet on the technology of tomorrow.
So imagine the compounding effect. When you combine a 4.5 billion annual R&D bet on quantum cryptography and autonomous AI with a 53 billion backlog of hardware orders, what does the end result actually look like?
Right.
Will the military frigates, the European satellite constellations, and the cyber defenses that Thales rolls out at the end of this decade be completely unrecognizable from the ones they are manufacturing today? We're looking at a company that isn't just fulfilling current global demand. They are actively financing the reinvention of the underlying technology itself.
Will quantum encrypted comms and AI-driven airspace management become the baseline standard by 2030?
Exactly.
That is a fascinating thought to leave on. Are they just building smarter missiles today, or are they quietly funding the sci-fi reality of the next decade? I suppose we will have to wait for the 2030 financial results to find out. Thank you so much for joining us on this deep dive.
It was a pleasure.
We hope this helped you decode the massive numbers and the shifting geopolitical currents hiding in plain sight within these corporate pages. Keep exploring your sources, keep questioning the data, and above all, stay curious. We will catch you next time.